Right now, artificial intelligence is triggering one of the largest technology expansions the market has seen in decades. Billions of dollars are flowing into AI infrastructure, data centers are scaling, automation systems are spreading across industries. Governments and corporations are racing to deploy intelligent technologies faster than ever before. But here's the catch. While most investors are focused on the massive AI giants, companies already worth hundreds of billions, there's an entire layer of smaller companies quietly operating underneath this expansion. Companies that build specific pieces of technology that the broader AI ecosystem depends on. And today we're looking at two of them. One is trading around $1.50, the other is trading near $4.18. Both operate in areas connected to AI-driven innovation, yet they remain largely invisible to the broader market. So the real question becomes, are these simply small speculative companies? Or could they be early players in areas that become more valuable as AI adoption accelerates? Now this is where things start to get interesting. To understand why smaller companies like these can appear on investor radars, you have to zoom out and look at how technological waves usually unfold. Every major technology boom tends to follow a similar pattern. The first companies that capture attention are the large, visible leaders, the platforms, the chip manufacturers, the massive software providers. But beneath that surface layer is an entire network of specialized technologies. And this is where pricing inefficiencies sometimes appear, because institutions and professional investors often look beyond the obvious leaders to understand which supporting technologies might become important if the broader industry expands. That doesn't guarantee anything, and smaller companies carry significantly more risk. But it explains why certain niche technology areas quietly attract attention long before they appear in mainstream headlines. And this is exactly where smaller cap opportunities sometimes begin to form. The first company operates in a very unusual corner of the technology world. Instead of building software or data infrastructure, it focuses on advanced neurotechnology designed to interact with the human brain. Specifically, it develops systems that use magnetic stimulation to target specific regions of the brain in a controlled and measurable way. Now, at first glance, that might sound unrelated to artificial intelligence, but here's where the connection appears. As AI-driven healthcare systems expand, especially in diagnostics and treatment personalization, technologies that can measure, monitor, and influence neurological activity are becoming increasingly relevant. But here's the catch. Despite operating in this emerging intersection between healthcare technology and AI-driven analysis, the company itself remains extremely small compared to the massive healthcare giants dominating the industry. And later in this video, the second company we'll discuss approaches innovation from a completely different direction. Mental health treatment is one of the fastest-growing areas within modern healthcare. And as machine learning models become more capable of analyzing neurological patterns, treatment technologies that interact directly with the brain may become part of larger AI-assisted care systems. If AI-driven healthcare platforms continue expanding, then companies developing specialized neurological technologies could become increasingly relevant within that ecosystem. But again, that's a conditional scenario. And timing plays a huge role in whether smaller companies actually benefit from these broader trends. Now, this is where the stock history becomes interesting. At various points in the past, this company's share price traded significantly higher than where it sits today. Over time, the stock experienced volatility and eventually pulled back to much lower levels. Today, it's trading close to $1.50 per share. So the question investors sometimes ask is simple. Is the current price simply reflecting ongoing challenges? Or is the market overlooking potential future developments in the underlying technology? The company primarily generates revenue through the deployment of its neurostimulation systems across medical clinics and treatment centers. These devices are designed for therapeutic applications related to neurological and mental health conditions. And as healthcare increasingly incorporates data-driven treatment models, technologies like this may become integrated into broader digital health ecosystems. But this is where things shift. Because when you actually look at the company behind this technology, you'll find it's called Neuronetics Inc., trading under the ticker STIM. And at the moment, the stock is sitting around 151 per share. Now, the reason smaller companies like this remain at low prices is usually straightforward. Healthcare technology development can take years. Regulatory hurdles are complex, and market adoption is rarely immediate. So this doesn't mean the stock suddenly moves tomorrow. There are real risks here, and timing is often the single biggest factor when it comes to small-cap companies operating in emerging technologies. Now, before we get into the second stock, here's something many investors overlook. Even though AI adoption across industries is accelerating rapidly, the companies enabling specific applications, especially in healthcare and specialized technology fields, often see delayed market recognition. And that lag between technological relevance and investor attention is sometimes where unusual price dynamics appear. Which brings us to the second company. But unlike the first company, which operates in neurological treatment technology, the second company approaches healthcare innovation from a very different angle. Instead of focusing on the brain, this company focuses on advanced cancer treatment technologies, and more specifically, it develops systems designed to improve how therapies are delivered directly to tumors. The company's technology aims to enhance the effectiveness of certain cancer treatments by improving the precision of drug delivery. In simple terms, the goal is to help therapies reach tumors more efficiently, while minimizing damage to surrounding tissue. Now, this is where artificial intelligence could eventually intersect with technologies like this, because AI-driven medical systems are increasingly being used to analyze treatment data, predict responses, and personalize therapy strategies. If AI continues transforming oncology research and treatment planning, then technologies that enhance how therapies are delivered could naturally become part of those advanced treatment ecosystems. But again, that's a long-term scenario, not an immediate outcome. And early-stage healthcare companies face a long road before widespread adoption. Looking at the stock itself, the price history has also shown significant movement. Like many small biotech companies, the shares have experienced volatility over time. After trading higher previously, the stock eventually pulled back and stabilized around much lower levels. Today, it's trading close to $4.18 per share, which raises the same question investors often ask in these situations. Is the current price reflecting risk or potential future developments? And this is where it gets interesting, because the company behind this technology is TriSalus Life Sciences, trading under the ticker TLSI, currently priced around $4.18 per share. Like most smaller healthcare companies, it faces real uncertainty. Clinical adoption takes time, revenue growth can be uneven, and biotech development carries significant risk, so this doesn't guarantee anything. But it explains why some investors watch emerging healthcare technologies closely. So now, the interesting comparison appears. The first company focuses on neurological treatment technology. The second focuses on advanced oncology therapy delivery. One sits around $1.50 per share, the other around $4.18. And both operate in areas connected to the broader transformation happening in healthcare technology. But here's the real tension investors think about if AI-driven healthcare expands rapidly. Which type of company benefits first? The neurological technology provider that could integrate with digital mental health systems, Or the oncology treatment platform working within cancer therapy innovation? Both scenarios have different timelines and very different risk profiles. When looking at companies like these, the key takeaway isn't predicting short-term price movements. Instead, it's understanding how smaller technology providers sometimes exist within larger industry transformations. Artificial intelligence is pushing healthcare toward more data-driven, personalized treatment systems, and the technologies that enable those systems often sit quietly beneath the surface. This is the layer of the market that tends to move later, but sometimes more aggressively if adoption accelerates. If you enjoy exploring smaller companies connected to emerging technology trends, consider subscribing for more research-driven breakdowns like this. And as always, this discussion is for educational purposes only, not financial advice.